It's a new week, and we've got a lot to talk about.
Obviously, there's concern even in the U.S. Treasury market, again, with the uncertainty out there and the way foreigners now look at the U.S. Treasury market. And I know we've heard this before, like, oh, the people are going to stop buying treasuries, and typically they don't, but it's a risk. So we are going to be much shorter duration in this thing, and we're concerned. You could have rates stay elevated, and I think people are assuming, oh well, they're going to come down, and not quite sure. I don't think that's the case.
That's Fritz Folts, Chief Investment Strategist at 3Edge Asset Management. He's batting cleanup today in the big interview, and we're covering a lot of ground with him. But up first, Selma Hepp, Chief Economist at Cotality, Chairperson of the National Association for Business Economics Business Conditions Survey, which is out today and in which economists say the odds of recession are way up, no matter what the hard and soft data are saying. Plus, we've got Daryl Fairweather, Chief Economist at Redfin, talking about her new book, Hate the Game, Economic Cheat Codes for Life, Love, and Work. And David Traynor takes us to the danger zone as we revisit a stock that's been in twice before.
Today's Monday. Otherwise, I wouldn't be wearing this I Hate Monday shirt.
I don't really hate Mondays. I love living the money life every day of the week, so I'm glad to be here, even if there's a little bit of nervousness and potential trouble out there, stuff that we couldn't have prepared for entirely as we were getting this show ready, but that we will be talking about later this week, specifically with the downgrading of U.S. corporate debt, where on Friday, Moody's Ratings removed the final major AAA credit rating for the federal government, which means that America's debt is no longer considered pristine by any of the main rating agencies. In case you missed the story, Moody's said successive bipartisan failures to reverse the growing U.S. deficit, which it estimated could reach 9% of gross domestic product within the coming decade from 6.4% last year. That is the real reason here. You can downplay this, and there will be people who do. If you're old enough and you've paid attention to stuff, which I am and I have, you've heard stuff dating back decades, right? Like Greenspan was talking about this, saying it was going to happen back then. And of course it didn't, but that doesn't mean you shouldn't be concerned. So we're not going to discuss that on today's show, but we will be talking about it. On today's show, however, Selma Hepp is here. The NABE survey is out just now, and we've got the first look at it. Yeah, the numbers are ugly in terms of what economists are expecting could be happening. And again, they could whipsaw based on what we get next, but you never know. And speaking of economists, Daryl Fairweather, I love the book. I love this book because everything's an economic decision. You may not think of it that way, but virtually everything you do has some measure of impact on the economics of your household, if not bigger and broader economics. So love this, that it kind of focuses everything that way, which I know is not the way most people think about it, but it's not a bad way to think about it, particularly now as you're watching all these things that we grumble about where it comes to higher prices and inflation, but you're not necessarily making the other half of the economic decision, right? I mean, at what point, if you do this, it was funny. Gail and I think I mentioned it last week, had recently, Gail picked up an order at the sandwich shop and was just surprised at how much it cost, which was like almost $30 for one large and one medium sub. And if what you want is a sub, you can do it for a lot less than that if you're going to do it yourself, or you can eat something else, or, peanut butter and jelly or whatever it is. But at what point do you say, wait, hold it, the prices have gotten high enough that they impact my economic decisions? Well, this book talks a little bit about that and goes into a lot of other areas. So we'll have a fun chat with Daryl Fairweather. I'm Chuck Jaffe, financial columnist, your host here on Money Life. Reach me at chuck@moneylifeshow.com. I would love to hear from you. But right now, we're going to jump right in, because otherwise this show will go way over our normal time limits. So settle back and relax. We start the talk with up to the minute, the most current economic news we can possibly give you when we talk about what the survey says next.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
We start this week's talk looking at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are not just talking about people or ordinary people, we're talking about economists, because on Monday the 19th, this morning, the National Association for Business Economics has released its latest business conditions survey. And this is one of the ones you want to be looking at, because when business economists are changing their forecasts, that means companies are changing their spending. And we've been waiting to see how everything was going to be responding to the tariff policy changes and all the rest. This is where we start to see the rubber meet the road. If you want to learn more about the survey, NABE.com is the website for the National Association for Business Economics. Joining me now, Selma Hepp. She is the chairperson of the NABE's Business Conditions Survey. She is chief economist at Cotality, which you may know as by its former name of CoreLogic. Selma Hepp, welcome to Money Life.
Thank you. Thank you so much for having me.
This is, I think, the first of the business conditions surveys where we really are starting to see we've lived a little bit of tariff policy. And although the tariffs have softened up and we've seen delays and changes, what we're also seeing is delays and changes to spending plans, to hiring and investing, right?
Yeah, absolutely. I mean, there's been quite a bit of sentiment change in terms of what people are thinking about the recession, entering recession over the next 12-month period. To give you an example, in our January survey, only about 15% of panelists had put probability of a recession over the next 12 months at more than 25%. Now, 75% of panelists put the probability at more than 25%. So significant shift just in the last, few months in terms of how we are responding to these ongoing policy shifts.
And yes, that shift towards recession, the number, like I said, the one that stood out to me was that there are far more firms that are saying we've got to delay our plans till we get some clarity.
Yeah, so, people are really not sure, in all honesty, how to respond. So they're in wait and see mode at the moment. So majority of them were not doing much. They were waiting in the first quarter. They weren't spending on capital. They were, holding on to hiring. They were making no changes to prices, but most of them expect that to change going forward, at least in terms of higher prices. Some are expecting higher share, for example, of respondents are expecting layoffs going forward. They're expecting material costs to go up for them, which then turns into higher costs for consumers. So yeah, a lot of changes going on right now in terms of what to think about going forward for business conditions.
Since we now have a 90-day pause in the China tariffs, that basically puts us, when you're doing the next survey, the next quarterly survey, and we right around as that ends, we don't know what that's going to turn out. How much is that weighing on the numbers we're seeing right now?
So I mentioned how, a lot of respondents are concerned about the recession, but another 60, almost 60%, 59% of respondents are saying that the uncertainty over the implementation and timing of the policies from the new administration is the biggest downside risk to their company's outlook. So this uncertainty is feeding into their uncertainty about what their company is looking at going forward.
You're an economist. You're one of the folks who is part of this survey, et cetera. You talk to economists as part of NABE. But was there something here where you were a little surprised that economists, the bulk of them were kind of seeing something maybe that you didn't expect?
Well, maybe because we're economists, there is a collective thinking in there. So, we all seem to come to similar conclusions. So I don't know if necessarily to me, some of this stuff was different than what I was expecting we would see. But, to just a regular audience, I think it is surprising to maybe see how much the risk of recession has increased. The other thing is, respondents are very concerned about what happens to central bank independence independence. Majority, 84% of respondents said that they believe that central bank independence is very important, and 10%, so almost 95% think it's very important or important. And it's important to fostering supportive business conditions. So, maybe to regular audience, it's not something they think about immediately when they're thinking about central bank independence, but to us, it's something that we need to keep a close eye on going forward in light of ongoing policy changes.
I'm glad you mentioned it, because here on Money Life, we have been talking about it a lot, like a lot more than others. And in fact, audience members have said, I didn't really think about the importance of central bank independence, but we've been asking a bunch of questions about it for that reason. It's good to know that the economists are concerned there. The other side is this is early, and this is about business conditions. So we're still getting the feel for this. I have to say, I didn't find this number as I prepped for the interview, but I know that you guys are normally asking about prices. So are the economists saying that their corporate costs are going up, that they are experiencing higher costs? And then in turn, is there any information about whether they're passing those costs on?
Yeah, we do ask about the prices. And, while the majority have yet to see changes in prices, mind you, this survey was in the field in the week of April 21st to 30th. So this was prior to the announcement of reduced tariff rate on imports from China. But, it also was in the middle of all the uncertainty about what happens with tariff rates. Nevertheless, going back to the survey, it reports on a first quarter. So in the first quarter, the majority of, or 67% to be precise, of respondents says they didn't see changes in prices, but higher share than in a previous survey said that they're expecting rising prices in the next 3 months. And then when asked what happens to those prices, do they pass them on to the consumers, increasing share also said they're likely to pass them on to consumer as they experience themselves higher prices.
That's the expectation on what's going to happen to higher prices. What's the expectation on layoffs? Because I know that's another question you always ask.
That share too went up. More respondents now than, in January survey said that their company is more likely to have layoffs. So about 38% of respondents said that they're more likely to have. Last in January survey was 26. So, it's a 12 percentage point increase. That's significant in the scope of this type of survey.
It is significant. The numbers certainly suggest that there's a lot of significant changes going on. Selma Hepp, thanks so much for joining me on the show to talk about it.
Thank you so much for having me.
That's Selma Hepp. She's the chief economist at Cotality, formerly known as CoreLogic, but she's here in her role as chairperson of the NABE Business Conditions Survey. Go to NABE.com to learn more about the survey, to find the results, and learn more about the National Association for Business Economics. And we are just getting started on the May 19th edition of Money Life. So settle back and relax. There's a lot more to go, and we get to it in a moment.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at Vetify.com.
Did you know that there are at least 23 million American adults who can't read a want ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We sure can, and the story today is that you can improve your life by just focusing on everything from an economic standpoint. And I know you hear me say all the time that I've got a degree in economics, so I don't consider what we're talking about necessarily secrets, but I am always finding out that people don't think about economics in the way that anybody who's ever studied economics thinks about it. And today's book is going to help you put economics in focus in pretty much everything, because my guest is Daryl Fairweather. She is the author of Hate the Game, Economic Cheat Codes for Life, Love, and Work. And if you want to learn more, hatethegamebook.com is the website. By the way, you might also know Daryl as the chief economist at Redfin. Daryl Fairweather, thanks for joining me on Money Life.
Thank you for having me.
Like I said, economics is a huge force in everyone's life, not just those who study it. But why does the average person who thinks they don't really need to know much about economics need cheat codes?
Well, I think economics is useful in nearly every aspect of life. It's all about decision making. And I make decisions all day long, and sometimes they don't really have to do with money. But then when you dig in, there are trade offs that are being made, there are benefits and costs to every decision. So, looking at the world through that lens and understanding the principles of economics can help you make better decisions in any arena, whether it's life, love, or work. And I don't think people really appreciate that or understand how beneficial economics can be to their everyday lives. So that's what I'm trying to do with this book is just spread that knowledge.
I love that way of thinking because so many folks look at things pretty much entirely based on I'm making this salary. I don't look at it that way. In the springtime, my hobby job is that I officiate lacrosse games. But what I actually say I'm doing is I'm doing my yard work. And people go, but you're not out cutting your grass. I am. I'm making the money that pays the guy that cuts the grass, doing something that I really enjoy doing. That's the thing, because people think that the economics is all about the numbers, but it's not all about the numbers. It's about the decisions and the way you value things. And many of those things don't have a monetary value. So help people understand how economics works on something with no monetary value.
Yeah, so one example of that is leisure time, as you were describing. So during the day, we have time, and the phrase "time is money." It rings true for me because you're making trade offs with your time. You could be earning money. If you're not earning money, then that's money that's not going in your bank. So it is costing you something every time you decide to say, take the day off from work and just lounge by the beach. There is a value associated with that, and looking at it that way, I think helps you make that choice of whether you should be working or not be working. You could spend time working, making more money, but if you're not spending that money, it's probably not bringing you any value. So deciding how to both spend your time and your money is a really important thing to break down. And if you can't quantify it with dollars, you can still quantify it with trade-offs. Like if I'm not going to be spending an hour working, I'm going to be spending an hour at the beach. There's still an implicit cost there.
Let's bring this over to current events and talk about tariffs and rising prices and things along those lines. I'm somebody who loves to cook. I'd rather cook than go out for meals most of the time. But I don't cook what I say, oh, this is what I want to eat. I let the grocery store determine what I'm going to make because it's what they put on sale. Help walk people through why increases in prices are one decision that while people grumble about what's happening, it should actually make them rethink their whole process from an economic standpoint.
Yes. If the conditions change, then your decisions should probably change. And I mean, at least some aspect of them should. So with tariffs, prices are going to go up for some goods and services, but prices will actually go down for other goods and services. So for example, importing, say, toys from China, that might become more costly, but it actually might make you decide, well, instead of spending money on toys for my kids, I'm going to take them for a walk in the park. And that will still be the same price free, but actually the opportunity cost with your wages are still there. So that trade-off might change. Like instead of spending money on that toy, you might spend money on an experience or spend time on an experience. And if you aren't changing your behavior when those prices change, then maybe you weren't optimizing in the first place. Maybe you weren't really internalizing those prices to begin with. So I think when the prices change, that is a good opportunity to reevaluate how you're spending both your money and your time.
Optimizing is an interesting word when it comes to the investment world. I typically hate most of the things that are driven by, hey, let's optimize this, because there are suboptimal outcomes that people often don't think about when it comes to personal finances and these decisions. So, how important is it that we optimize and help us figure out, is optimal about the most money or is it about the most leisure? Or does that totally depend on your circumstances where, my hobby gig pays for the lawn? Somebody else would go, no, I need that to pay for the bills.
Yeah, I think spending your time and money optimally is more of a goal, a North Star, than something that can ever actually be achieved because you're never going to have perfect information about what happens in the future or even what's going on right now. If you might have an optimal investing strategy for retirement, but if you don't live long enough to make it into retirement, then that, ex post isn't the most optimal way to be spending your money. So you can never really know for sure what would have been the most optimal decision to make. But what you can do is with every decision, think about the costs and benefits, or how I phrase it in my game, the inside option and the outside option. So, for example, if you are deciding whether to put your money into your retirement account versus spend your money on a vacation, you can weigh the costs and benefits of each. One is that you get enjoyment now, one would be that you get enjoyment at some future date that may or may not come. And you're never going to know for sure what is going to be the right answer, but you can at least try to get close to it, and you can try to check your own personal biases. Like if you are spending money on a vacation because all your friends are going on vacation and you feel this pressure to go on vacation with them, thinking through that a bit more and really introspecting about what your personal values are will get you closer to that optimal decision than if you just go on some gut instinct that you need to keep up with your friends or you're going to be socially punished or something like that. So thinking about those values and breaking down the costs and benefits, I think, is a good exercise to do, even if you're not going to get to that perfect answer.
One thing I really enjoyed about the book is that it does get into game theory and it kind of gamifies a lot of these decisions. When you gamify stuff, the potential problem is that people focus on the win. And again, we've been talking about tangible versus intangible. So how do you gamify something and still say yes, but intangibles win?
I think the benefit of gamifying your choices is that it kind of, at least for me, it makes me feel less emotionally attached. Like when I'm playing a board game, I'm not really thinking about whether or not the decisions I make are the right decisions, or if, am I going to regret this decision that I make? I'm just trying to beat the game. And it doesn't, I guess that helps me detach from these decisions, to just think of it as a game. Like I'm just trying to get closer to winning. Maybe I'll win, maybe I'll lose in some sense, but playing should be the fun part also. But yeah, when it comes to, I think, over gamifying things, one thing I warn about in the book is getting into a trap of just trying to win external prizes, like that next promotion. There's always going to be another promotion to go after. And I think at some point you do have to really introspect and reevaluate, what does winning mean to you? Because it can't just be getting as much money in your bank account. Or maybe if that is what your goal is, I mean, maybe think about that a bit more if that's how you really want to be living your life. Because at a certain point, you need to start actually enjoying things, or else I don't think you're winning.
In fact, one of the other key points I took out of the book is that what all of this is really designed to do is to give you more control. And okay, I made the joke about how I let the grocery store decide what I'm cooking, but I'm cooking it. I'm making the actual decision. So I'm gamifying it. Hey, what's it going to be this week? Okay, here comes the circular. But I'm also doing the flip side of that, which is I control what I actually make. But I just think that people right now are feeling very much out of control when it comes to their economic decisions. So let's help them get some control. Without giving away too much of the book, let's talk about 1 or 2 points that you'd like to see pretty much everybody do to improve their control.
Yeah. So, well, one concept in economics is this idea of an economic agent. That's the definition of, or that is the basis of making choices, is that you have agency. You're making choices, and there are constraints that are outside of your control, but within those constraints, you can make choices. And one choice that I think people should think about more is deciding which games they want to be playing in the first place. So if perhaps now you're working in some corporate job and you get laid off for reasons outside of your control, you can keep trying to play the corporate game, but there are also other choices out there available to you. Like you could become an entrepreneur, or there are other maybe nonprofit games you could play. You don't necessarily have to tie yourself to just one type of game, one type of identity, but I think people often do that, and that's why they feel they don't have as much control as maybe they really do have.
Among the decisions the book helps people with are things like going to college, buying a house versus renting, stuff along those lines. One of the things I see all the time is that there are plenty of studies that talk about regrets that consumers have. But those regrets are obviously always with hindsight. You think, I'm going to go live the American dream. I'll buy a house. And then you go, wow, I didn't realize that the upkeep would be this much or taxes would be that much. If we're going to try to gamify this, if we're going to try to give people cheat codes so they get the right outcome, are we telling you you've got to know your career when you're 16 and you're getting ready to go to college? How do we deal with these big life decisions that people think their whole lives, this is the way you're supposed to do it, that they might have regrets about later? How do we tackle those big issues?
Yes, when you're in your 20s, it's probably pretty unlikely that you know exactly what you're going to want when you're in your 30s and your 40s and your 50s. Your goals are going to change. You're going to discover more about yourself. So I think early in your career, it should be more about exploration, finding what you're good at, what you enjoy, and realizing that just because you initially committed to one career path, give yourself the permission to change at some future date once you do discover more about yourself. In economics, the concept is that we're always trying to like optimize according to some utility function, but we don't get our utility function written down for us. Like, this is what you should be aspiring to in life. It's something that we have to discover through our experiences. And I think that it's okay to make mistakes. It's okay to switch careers. One thing that you shouldn't fall for is the sunk cost fallacy, which means incorporating costs that have already been spent into current decisions. What happened in the past, you can't change. So it shouldn't be part of your calculus moving forward and making new decisions. I mean, you learn things and you can incorporate that. But one example is that I bought a house in my late 20s that I probably shouldn't have bought because I ended up switching jobs shortly after that and moving to a new city and needing to sell that house. And I sold it, I mean, at a small loss, but still somewhat of a loss after taking into account closing costs and real estate fees. If I had gotten hung up on this idea that I made the wrong decision, it would have been harder for me to admit that I needed to sell that house. But because I know about economics and the sunk cost fallacy, I knew that that shouldn't be a decision. Like, if I am trying to move for a better job that's going to set me up to be better off in the future, that's what matters, not what happened in the past.
And I've got a very similar story in my past from early on in my career where, yeah, the job and the rest of it changed. It paid off, but at the time, super painful to go through. But last, I've got to ask, because we've talked about everything else, give the audience an idea of how economics plays in love decisions.
Yes. So I think there's two different kind of parts of the book where I talk about love and relationships. One is in dating. I give this example from this movie, Two Can Play That Game, starring Vivica A. Fox and Morris Chestnut. Basically, in the movie, Morris Chestnut starts stepping out on Vivica A. Fox, and she has to figure out how to win back his affection and loyalty. So what she does is she goes out and flirts with a bunch of men and puts that on display in front of him. So he realizes that she has all these better options and that he might actually lose her. So that's one example, but I actually don't think that kind of gamifying or tit for tat in relationships is optimal. Once you commit to a partner, it should be more about how can you align your goals in a way where you're not actually up against one another all the time. Because like the classic problem in marriage is that one person wants to do one thing, say move to one city, say the West Coast, and another partner maybe wants to move to the East Coast, and they have to figure out how to come to a compromise. But a compromise is just another word for a negotiation. And in a repeated negotiation, you don't want to, basically annoy your partner or do brinksmanship where you're always threatening to divorce or something like that. You do want to figure out, well, how can you get on the same page about what your goals are so that the costs and benefits are, you're coming at it from the same point of view with you and your partner. Another thing I talk about in marriage is just this idea that the income that your partner earns, it's a joint income. So if you want to stabilize your income, you'd be better off marrying somebody whose income is negatively correlated with your own. I mean, an example of this is like a bankruptcy lawyer, say, marrying somebody who is a lawyer for big IPOs and acquisitions, because one is going to do well when the market is down, the other one's going to do well when the market is up, and those kinds of relationships actually do have lower divorce rates, believe it or not. So it should be a consideration, like, how are you going to optimize this joint income? And if you have the same goals, it's going to be easier to do that than if you're on completely different pages about what your goals are in life.
Well, as I described on the show recently, my wife and I have been doing some things trying to make sure that our goals are properly aligned. I just didn't think of all of them quite as economically focused as I did after this conversation here. Daryl, this has been great. Thank you so much for joining me on the show.
Thank you for having me.
That's Daryl Fairweather, chief economist at Redfin, author of Hate the Game, Cheat Codes for Life, Love, and Work. You can get more information at hatethegamebook.com. And we will be having some copies to give away in a contest, though the contest is not today. But what is today? Fritz Folts from 3Edge Asset Management. And up next, our own personal cheat code on the market, David Trainer from New Constructs is here as we head into the danger zone. Stick around. This is Money Life. If you're looking for trouble, you've come to the right place. You're in the baddest biker bar in the investment world, the Danger Zone. Yes, welcome to the Danger Zone. That's where we get the latest take on stocks, mutual funds, and more from David Trainer, founder and president of New Constructs, where they evaluate securities on a scale of most attractive to most dangerous, bringing together discounted cash flow analysis and forensic accounting. They dig in at the footnotes level, and they work their way up. And what they find is that the people who don't work their way up, who give you a top-down, skin-deep picture, are often giving you misleading details. And if it's misleading and that means something's headed for trouble, well, that makes something dangerous. Learn more about how it works by going to newconstructs.com. David Trainer, great to chat with you again.
It is great to be back, Chuck. Thank you.
Who's in the danger zone this week?
Marqeta.
Danger.
Marqeta. It's ticker symbol MQ. And this is not the first time in the danger zone for the stock. It's not even the second time in the danger zone. You came out against this stock a couple of years ago as it was an IPO. And you came out against it again in 2024, and it's at about the same level now that it was then. It took a significant haircut after that last warning, so now it's on the rise. Is it in the danger zone now because it's been on the rise recently, or is there something else that has us revisiting Marqeta now?
Yeah, no, it's just one of those situations where, it went way down. We thought it was going to maybe put itself out of its misery, but it's back some, and we want to get back in front of investors and tell people to watch out.
Marqeta, we should point out, is a digital payment company. And if I'm not mistaken, the company changed CEOs recently. Now, one of the things that you and I seldom talk about is what's happening with management. Like, you're distrustful of everybody's management as you're reading their numbers. But I'm curious, when you've got a company that you think is headed for trouble and they're going through a management change, how much does that raise a red flag or an extra red flag?
Absolutely, Chuck. Absolutely. When you see turnover in the senior ranks, things aren't good. It's the same thing is true in sports, right? You don't want to be turning over your head coach, if at all, ever. And a company is the same way. It's typically, the sports analogy keeps going. Typically when the team's not doing well, you fire a coach, you fire a coordinator, and they're the scapegoat. It doesn't usually make things better, but it usually reveals that there are bigger problems. So big that the current coach is believed to be taking the business or the team in the wrong direction. And that's what we're seeing with Marqeta, right? With declining take rates, declining economic profits, misleading adjusted pro forma numbers like adjusted EBITDA, an evaluation that is just absurd in ways we don't often see.
So let's get into that, because this valuation was absurd when the stock came out of the box. Like I said, you picked on it in 2021 when the company went public, and it came out and got close to $30 a share, if I recall. Now it's trading at about $5 a share. And again, that's up significantly from where it was just a couple of months ago. How out of whack are these numbers, given that this company has been hammered so hard?
Yeah, it's a percentage game at this point, clearly at $5. And we struggle with this. We got a lot of danger zone stocks. We just had a meeting earlier this week. Danger zone and zombie stocks that are trading down below $5 a share, sometimes around $2 a share. It's like, well, should we just close this? Right? Because we're seeing a huge gain and outperformance for a lot of these. Like, for example, for Marqeta, it's outperformed as a short call for us by 124%, right? It's down 84% while the market's up 40%. And so, you wonder, how long should we pat ourselves on the back here before we just sort of take it to the house? but it's up 36% year to date. We've seen a big junk run, Chuck. We've seen a big junk run in the last couple of weeks with the markets, stuff going up like crazy. So I think it's part of our obligation and part of our mission at New Constructs to just come out and raise a red flag on stocks as we do that could be of real risk. And this was one of them. I mean, so jumping to answer your question, the current valuation implies that Marqeta will be larger than PayPal. And what they've got to do is improve their margins from negative 26% to 7%, which is half of PayPal's margin. But that's still a huge swing. And at the same time, grow revenue at 30% compounded annually for the next decade. So it's like you're talking about, it's not even a hockey stick. It's like a, I don't know what it is. It's transformation. It's like Frankenstein. I don't know, something impossible or ridiculous. And so that would imply $7 billion in revenue in 2034 and $517 million in NOPAT in 2034. It would imply a total processing value of $4.1 trillion, which is 2.5 times PayPal's trailing 12 months total processing volume.
Yeah, and so it becomes impossible because it's not like these guys are going to overtake PayPal, which then demands the question, is there any stupid money risk where somebody like PayPal would say it's worth it to buy Marqeta?
Yeah, the thing about stupid money risk is, how do you ever really predict stupid?
Right.
Stupid wouldn't be stupid if it were rational, logical. So that's why we had to call it stupid money risk. And that mattress firm example, I think I'll never forget that. Like that was just, someone got paid something somewhere because that company bought Mattress Firm and immediately wrote off like $100 million or whatever it was. It was absurd. So yeah, I don't really know if there's a lot of value. It feels like a pretty commoditized business now, payment processing. So I don't know. It's not a zombie stock because they've got too much runway. They do burn a lot of cash. Yeah, as I said, the economic book value is negative $2.50, and they got a negative 26% margin right now. So I don't know what to say except be fair.
Well, what we can say is
You can't fix stupid.
And while we understand that you can't fix stupid, you can't guarantee there's stupid money risk that somebody's going to come and bail it out. But what it also sounds like is that this company can bumble along for a long time. And if that's the best thing you can say is like, we've got a long runway before we become a zombie stock, but it doesn't have much in prospects, even if you're not going to short it, which is pretty hard on stocks that trade this low, you just kind of have to think there's no there. Like, there's not a compelling reason to own it, even if there's not a reason to justify fully betting against it.
That's right. They've got, at their current burn rate, 8 years of cash. That's what an overpriced IPO is supposed to do, especially kind of in the era we came out of, Chuck, when we had all these kind of crazy IPOs and the private equity guys are making so much money. And you've got SoftBank just, with billions of dollars. What they do is they get this high priced IPO. It raises a bunch of cash. Private equity guys sell out over time. So they lock in their gains, and you've got, it's a zombie. It's one of these zombies that's going to live for a long time.
Yeah, again, there's no there because the economic book value on this one, I'm assuming, is negative.
Negative $2.50.
So ultimately, the no growth price of this stock is how big a haircut from the $5 a share it's trading at now?
That's a negative $2.50. That's the economic book value, is the no growth value. Negative $2.50. So yeah, the math gets funny when you go negative, but yeah, it's 150% below, I guess you could say, the current stock price.
And that's why Marqeta, MQ, is in the danger zone. It's already experienced plenty of trouble, but apparently it's headed for more. David, great stuff. As always, thanks for joining me on the show.
My pleasure, Chuck. Thank you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com for more information, to find their most attractive and most dangerous stocks lists, and more. And of course, David is here every Monday on the show. But something that's also here every Monday, the big interview. And up next, it's Fritz Folts from 3Edge. He'll be here when Money Life returns right after this message.
Oh, wow. This is actually pretty dangerous.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome to the big interview on the May 19th edition of Money Life. Returning to the show, Fritz Folts. He is managing partner and chief investment strategist at 3Edge Asset Management. And if you want to learn more about the firm and about Fritz, it is 3Edge AM, 3, the number 3, 3edgeam.com. Fritz Folts, great to chat with you again.
Thanks, Chuck. Always a pleasure to be on your show. Thanks for having me back.
Yeah, you and I typically talk twice a year, so it's been about 6 months since the last time we had a chance to chat. There have been a few things that have happened in the last 6 months. So let's start with maybe a slightly different side of things, which is where we're at right now. Do we have to talk about all the stuff that's happened recently? Or are we now just kind of past it and we can focus on what's next?
Well, that's a very interesting way to put it, because I do feel like the world changed fairly dramatically on April 2nd when we had Liberation Day and we got the tariff announcement. And so in some respects, it's like nowadays, every time I pick up a hard copy of a newspaper, I say, well, this is already old. I got to get back online and see what's actually happening. But, I do think that we can look at the tariff announcement, this Liberation Day on April 2nd. This is a game changer. And it just introduces such a degree of uncertainty that from an investor standpoint, it's a tough place to be now, right? We had the tariffs announced on April 2nd. The market, the S&P was down, 20%. And yet now it's made back that 25% to get back to where it started. And that was based on the timeout, if you will, of the reciprocal tariffs and backing off of the tariffs on China. But trying to figure out where we go from here is really difficult. And as an investor, it puts one in a very tough spot. One interesting thing, I'll turn it back to you. No one talks about the Fed anymore. It's, you know what I mean? Like, it's amazing how much we were talking about the Fed, until we got into the tariff situation, at which point proving that, Donald Trump can drown out just about anybody, even Jay Powell.
Let's keep going on that theme, since the Fed is going to have a significant impact no matter what it does. Do you think the Fed's going to act anytime soon in terms of cutting rates, or is this not going to happen until the end of this year or maybe next year?
I feel that the Fed wants to cut rates. They'd like to be in a position to do that, but I feel that they are, and Jay Powell is feeling responsible enough for the dual mandate that the Fed carries. And I think, he's telling the truth when he says, we're comfortable here, maybe uncomfortably comfortable, but at least we're comfortable being where they are, and they don't feel like they're in a hurry to cut rates. The economy remains strong. Corporate earnings came in strong. The labor market is holding up quite well. And they are concerned about inflation, and the tariff uncertainty makes that, that's a real wild card now, the inflation number. So I would be surprised if we maybe we'll get a cut this year, but I would say closer to 1, maybe 2, but no more than that. And that's a lot different than where we were 6 months ago, right?
It's a lot different than when we were entering the year where the market was starting to price in 3 or 4 cuts. Let's get back to the uncertainty point. It feels to a lot of investors that if the market rebounded this quickly, it's a U.S. market. It's the best market in the world. It's super resilient. It can fight through anything. This is just another thing to fight through. But if you're a technical analyst, you can make a case that we aren't done with the April lows, that the April lows are going to be retested again in fairly short order. How much do you worry that after a bounce back, because we had a big reaction, we're going to settle in, get some sense of normalcy, but that the pressure will be downward and not upward when we get to normal?
Well, I think that's right. It certainly seems as though the rally that we've had has been retail driven. It's been the return of buy the dip, which is consistent that we've had for years now. This idea that if the market ticks down, you step in, you buy it, retail investors buy it, and it goes back up. The situation that we have now is the hard data is good. the economy's strong, the inflation numbers are good. All of this stuff is good. But the situation that makes it so uncertain is there have been, these events with the Trump administration, and most specifically with the tariffs, that have just created some degree of chaos. You have, how are you going to decide how to invest as a corporation? Do we make investments here? How do we think about that? What about pricing? Do we try to pass these price increases on to our customers? And so the hard data is good. What we're afraid of is a month or two from now, that hard data is going to be very different, because we're going to start to pay the price for the chaos created by the tariffs. And so if we are very cautious, and we're much more afraid of the downside than the upside here.
How are you responding in terms of equity exposure? Where are you putting money to work, et cetera?
So we're multi-asset investors, which means we can obviously invest beyond just stocks and bonds. But from our equity position in our core strategies, we're not at the minimum, we're not at the maximum. In fact, we're just about at the midpoint in terms of equity exposure. But we also have about half of that equity exposure ex-US, and we've been that way since the beginning of the year. So we're at about our midpoint in terms of total equity exposure, but we've divided that equity exposure 50% US and 50% ex-US. So that's how we look literally in terms of the equities that we hold. But then if we think about the hedges that we have to hedge that equity exposure, there we really do feel that just using, a 60-40 where you're going to have bonds hedging your equity is not going to be sufficient. We could very easily get into a stagflationary environment. We could have, the tariffs could cause inflation to resurge, and they could also slow the economy at the same time. And if you get into a stagflationary environment, your stocks aren't going to do that well, but your bonds aren't going to help you either. And in that case, that's why we hold some gold in our portfolio. We've held that for a while. That's a very good hedge against a stagflationary environment. We also hold TIPS in terms of the fixed income exposure that we have. Again, protection from inflation and stagflation. And in a stagflationary environment, quite frankly, you want to hold a good amount of short, very short-term, high-quality fixed income, almost cash equivalents. So that's the way we hedge our equity exposure, and our equity exposure is kind of right down the middle between aggressive and defensive.
You talked about your international exposure. How much of that is developed versus emerging? Because there's a significant difference in how those are going to be impacted by tariff policies on their end.
Absolutely right. And we basically split that 50-50 emerging market to Europe. The emerging markets are interesting to us, and obviously the decline in the dollar has helped there. But China is that's the big gorilla there. And there's just so much uncertainty because you just don't know what policy decisions are becoming. But in our ex-US equities, we still have some Europe that's treated us very, very well. But more recently, we've added a little bit more to our emerging market exposure. And typically what we do is we buy a basket of emerging market equities. If we had to pick one, I like India right now. Although, and in our most aggressive strategy, we have taken a position in India. But in terms of ex-US, I'm going to say we're about 50% developed and 50% emerging.
You like India right now, but that also means you're investing in an area in the world that has heightened tensions. Now, we haven't seen heightened tensions necessarily work too much against investors, unless maybe you had a significant exposure to Russia. But you're not worried about tensions, or at what point do tensions change your investment outlook?
Oh, yeah, we're worried, but we worry about everything. So we're certainly worried about that. The fact that we had this ceasefire come about pretty quickly gives us some comfort that it will hold. And so, the position that we take in India, it's a small position because, quite frankly, that's a risk out there that you just don't know what's going to happen. So we're worried about it, but we feel like this ceasefire could hold, and the position is, it's not an outsized position. And I think the prospects for India remain, favorable.
You mentioned gold. Is your position in gold in physical metal, or do you prefer the miners right now?
I love to talk about this. I mean, it's so exciting because obviously if the market's going up, you wish you had the miners. If it's going down, you're glad you don't have the miners. So in our more aggressive strategies, we will take small positions in the miners. It just gives you a little bit more beta. there. But in general, for our core strategies, we're going to the ETF market and getting exposure to, the physical gold, but through the ETFs. And it's just the miners are so volatile that, we don't use it a lot, although we might use some of that in our most aggressive strategies.
You talked about how if we get to a stagflationary environment, it's not particularly good for the stock market. It's not particularly good for the bond market either. And I'm curious, the stock market has rebounded. The bond market doesn't seem to be singing the same tune. And we've had times in the past where the two sides disagreed fairly strenuously on what was about to happen. And as a general rule, when there's too much disagreement, the bond market tends to win. Are you hearing the bond market say something different than what you're getting off the stock market right now?
Oh, yeah. I think that what you said is absolutely correct. If those two disagree dramatically, well, you better pay more attention to the bond market because more often than not, they're going to be making a better call than the stock market. And that's why we don't want to take really any duration risk in here. I just don't think it's worth it. And you get paid to be, shorter duration, stay in the treasuries. And obviously there's concern even in the US Treasury market, again, with the uncertainty out there and the way foreigners now look at the US Treasury market. And I know we've heard this before, like, oh, the people are going to stop buying treasuries. And typically they don't, but it's a risk. So we are going to be much shorter duration in this thing, and we're concerned. You could have rates, stay elevated, and I think people are assuming, oh well, they're going to come down, and not quite sure. I don't think that's the case.
In fact, when you look at these conditions and you're worried about what could happen with bonds, don't you worry more about, I don't want to call it image, but the changing perspective that the rest of the world now has about the US? That maybe it's just that before they saw us as an ally and now they see us at the other end of a transaction. But as the other end of a transaction, that's very different than dealing with your friend. And if they're less likely to invest here and more likely to invest elsewhere, doesn't that just change the calculus?
Oh yeah, absolutely. And I think we've seen that already. I mean, that's clearly already begun. And, it's a big question. And you don't want to sound hyperbolic and say that the system that we've been under for decades and decades since the end of World War II, where the US is a global leader in trade and just seen in that light, that's very much at risk now. And that has implications for the dollar and has implications for the US Treasury market. And it's not like we don't have a mountain of debt that we need to, continue to pay for. So that sets up a very scary scenario. I do think that at the very least, again, to not sound hyperbolic about it, but at the very least, we're in a much different global geopolitical environment. And I don't think we're going back to what we had. It's going to be a much more multipolar transactional environment. And that's going to make it potentially more challenging for us to continue to refinance or finance the debt that we're carrying, which is incredibly large and not getting smaller, by the way.
Given that, how much will your strategy, especially your long-term strategy, be focusing on what we get out of Congress? And it's not a political statement. It's just that if you can't get some progress on the debt and you can't stop it from growing the way it has been at the pace it's been growing, well, how much does that ultimately at some point make you say, I have to change fundamentally how I invest for the long term, even if I still think the U.S. is the best economy and market in the world?
We use our model to do all of our research. Our model actually goes back to 1872. And so what we want to make sure of is that we capture all these different environments. Then think about the world like that, all the potential, things that could happen in the world. And then we look and say, okay, in order to deal with all those potentialities, we need to have a very wide range of asset classes to construct these portfolios with, because at certain times you're going to be in difficult situations. You're going to have to find the appropriate asset classes for the situation, because there's always something that's going to be going up because people are going to be fleeing to that. For example, if there's a flight to quality, flight to safety, haven asset. And so fundamentally, we're not going to change, but the look of what our portfolios look like could be very different than it has since the financial crisis in in 2010. Perhaps the equity component is going to be much closer to its minimum, but the real asset component is going to be much higher. Maybe the treasury component, we could get into this financial repression, right? Based on where we are with the debt, because it just becomes a larger and larger piece of the budget. At some point, they could say, oh, we're just going to try, they're going to push long-term interest rates down, inflate your way out of that. We could face that situation. So we need to make sure that we have asset classes that we can use, and gold being a great example of an asset class you want to own if you're in that environment of financial repression. So fundamentally, we're not going to change what we do or our outlook, but our portfolios certainly could look different.
What's the asset class that you're looking at that not everybody is? I mean, I know the temptation is going to be to say private credit or something like that, which I think everybody's now actually looking at because I hear about it so much. But is there another asset for you that you believe people should be looking at that they're overlooking now?
I mean, gold, but everybody's excited about gold now, but it is still an asset class that if you get into, a stagflationary environment, if you have problems with your debt, it just covers your bases in so many different ways. That value of the dollar continues to decline. Gold comes to the rescue for you in many of the difficult situations that we could face going forward. Now, I know that at this point, a lot of investors are investing in gold because gold has gone up in value. So I'm going to buy it. That's not the way we look at it. We look at it much more as a hedge, and it serves so many different purposes, and so many of the eventualities that could be negative going forward from here. Gold will help you in those environments. So I'm going to stick with that as a first choice because I think it's a very misunderstood asset class.
Fritz, I appreciate the time and you coming back to the show. We will talk again in 6 months. So we'll be looking at that conversation as you're putting together your outlook for next year. But thanks again for sharing your perspective here today on Money Life.
Chuck, always enjoyed being on your show. Thank you so much for having me.
That's Fritz Folts. He's Chief Investment Strategist for 3Edge Asset Management. And if you go to their website, 3edgeam.com, well, you'll also find a link for their YouTube channel. And Fritz and Steve Cucciaro, their CEO and CIO, they do a little video review that you can get a link to. You might want to get that and check that out. And we'll come back and set you up for the rest of this week on Money Life before we wrap up the May 19th show right after this message.
Hi everybody, it's Rob Floyd, Money Life's executive producer, and this week we have a marijuana-themed contest for a chance to win Weed Empire: How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America by Adam Bierman, who appeared on the May 16th edition of the show. For a chance to win the book, you simply need to give us the name of a ticker symbol of a real marijuana ETF. Think tickers like HI, but for marijuana funds. Send the name of a marijuana fund with a fund pot-related ticker symbol, along with your name and address, to chuck@moneylifeshow.com by 6 p.m. Eastern Time on Wednesday, May 21st for a chance to win. Please put the word contest in the subject line of your entry. Good luck.
We're back to wrap things up. Thanks for sticking all the way to the end. If you were expecting the contest on Daryl Fairweather's book, Hate the Game, that is not a contest we are going to start today. We're going to hold that over. We've got some other authors coming on the show. We're going to put a couple things together, do it over the holiday weekend, because we have a contest going on currently as well. So, you can get in on that one if you want. But we'll hold that contest on Daryl Fairweather's book. We've got other great things coming, including tomorrow, Carl Mills, partner at Cerity Research. Later on this week, Chris Zaccarelli. We're going to be going off the news tomorrow with someone talking about the Moody's downgrade and what it means for the bond market, et cetera, things along those lines. So we're going to juggle things up based on the news. Of course, we are getting to a holiday week. We are here every day this week, including Friday. But we are not here next Monday. That is Memorial Day. And of course, it's not just Memorial Day. That's the main thing and what you should be celebrating. It's like the national holiday for lacrosse folks because NCAA championship weekend and everything else. So, and all of that, by the way, the NCAA championships here in the Boston area. So yeah, you can figure out how I may be spending at least some of my Memorial Day weekend. But lots of great things coming. Plan to be here. Meanwhile, if you're looking for something to celebrate today, well, it's Accounting Day. Do you really want to celebrate Accounting Day? It is Celebrate Your Elected Officials Day. And I want to point out, Gail and I went and voted in a town election this past weekend that did not get a lot of voters. I live in a small town, et cetera, but the kind of thing where you're putting somebody on the planning board and somebody to the sewer commission and somebody to each of those little things. I really appreciate those folks who serve, which is why even when you think, yeah, I kind of know how this election will turn out and I've read about the candidates or what have you, or even if you haven't read about the candidates, you may not go to vote. No, go do it. Like for us, we were celebrating them when we went and voted this weekend. But yes, the people who are giving of their time to be on your planning boards and your sewer commissions, let alone the folks who are doing it at the higher levels may deserve some of your contempt these days, but the guys at lower levels, they're doing stuff that a lot of us just don't have the time or the energy or the inclination to do, but you got to appreciate it. On the food front, by the way, it is National Devil's Food Cake Day. Yeah, I could celebrate that one for sure. My guests today were Selma Hepp, the chief economist at Cotality. She is chairperson of the NABE Business Conditions Survey, NABE.com. Daryl Fairweather, chief economist at Redfin, author of Hate the Game, Economic Cheat Codes for Life, Love, and Work, hatethegamebook.com. David Traynor, of course, is founder and president at New Constructs, online at newconstructs.com. And Fritz Folts, chief investment strategist at 3Edge, 3edgeam.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Monroe Mann, who said, "I'm not going to retire rich. I'm going to be rich by the time I retire." Yeah, that perspective really important because you want to make sure that you are getting rich slowly. You're taking things in perspective and keeping them in the right place day to day so you reach your goals. And to do that, remember, until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
I've got nothing left to say.